Social Security and how it is going to perhaps impact most of you, if not all of you, because of the State University Retirement System program that you're involved with. I'd like to thank Sue Benton and the Human Resources Department for arranging this session, and I hope that it is informative and that you understand how the Social Security benefits and your offsets may be impacted because you work for the State University Retirement System. I am not a Social Security expert, okay? I do not know all the answers to your questions. I am here to help you to gather the information that you need to have with respect to questions and the coordination of your benefits between Social Security and the State University Retirement System, okay? So I'm going to go back, say a few words. There's a couple other things that I want to go into with respect to my own personal situation with this. My wife is a federal employee. So I wanted to find out for our own benefit what type of benefits that we were going to derive from Social Security. And it was very interesting that because of my wife's tenure in the federal employee retirement system, if I should die, she will get nothing from Social Security. Zip, zero, okay? So in a lot of cases here, you may have a very similar kind of situation taking place. So keep that in mind. Also, when you are getting your Social Security statements, and the dollar amount that you see there may not necessarily be truly what the dollar amount that you're going to be getting from Social Security. Those coordinations of benefits are going to come into play with respect to the number of years that you have served here at the college and how high up the scale you're going to be in SURS. So keep all these things in mind when we're looking at this. Okay? I'm going to go back here and do a little bit of reading for you also. I've been with VALIC, which is one of the providers here of 403Bs. I urge all of you to participate in any one of the programs. They're all good. This is not a sales pitch. I want you just to understand the coordination of what you might need to have outside the realm of your State University Retirement System and the Social Security system. I want to read to you firstly a letter that one of your former colleagues received with regard to this particular situation. And it's a retiree who I just saw the other day. And the letter reads, "Thank you for contacting me in support of Social Security Fairness Act. I appreciate hearing from you. As you know, people who pay into the Social Security system for a certain amount of time are entitled to Social Security retirement benefits. In addition, their husbands or wives are entitled to spousal benefits. As a result, private sector workers who are covered by Social Security may qualify for 2 Social Security benefits. 1, a retirement benefit based on their own work, and 2, a spousal benefit based on the other spouse's work. However, Social Security won't pay both benefits in full. Instead, the spousal benefit is offset by the full amount of the retirement benefit. This is known as the dual entitlement rule. The rationale behind this rule is that spousal benefits are intended to help people who are financially dependent on their husbands or wives. Someone who receives a retirement pension of their own is less dependent on their spouse, and therefore Social Security reduces their spousal benefit accordingly. Before the GPO, or the government pension offset, government workers could receive a full government pension plus a full spousal benefit from Social Security. In contrast, the private sector workers had their spousal benefits reduced or eliminated because of the dual entitlement rule. Excuse me. Because of the dual entitlement rule. Thus, government workers received favorable treatment under Social Security. The GPO, or the government pension offset, was created in 1977 to address this unequal treatment. Under the GPO, a worker's Social Security spousal benefit is reduced by an amount equal to 2/3 of the government pension. In essence, the government pension offset creates a dual entitlement rule for government workers. Moreover, the Social Security Administration testified that the GPO is consistent with the concept of spousal benefits in Social Security. Namely, spousal benefits provide a safety net for people who are financially dependent on their spouses. And full spousal benefits should not be paid to people who have their own pensions. The GPO affects all federal, state, and local government workers, such as yourselves working in the state university retirement, state teachers retirement system, railroad retirement system, federal employees retirement system. All those have very similar kinds of defined benefit type of programs. And includes members of Congress who are not covered by Social Security. Some government workers are not subject to the GPO because they are directly covered by Social Security, and their wages are subject to the Social Security payroll tax, such as workers, federal workers, hired after 1983, and there are some state workers. If you're an IMRF employee, for example, you are also paying into Social Security, Illinois Municipal Retirement Fund. Although the GPO was created to make Social Security more just, some people agree with you, and this was written back to a response, with you that the provision should be reduced or eliminated. Several witnesses from the Social Security Subcommittee hearing during the 107th Congress testified that the GPO were reduced or eliminated, government workers would have an unfair advantage over the large majority of workers who are covered by Social Security. As a result, any changes made to the GPO must be considered carefully to ensure that all workers are treated fairly. With respect to the windfall elimination provision, or the WEP, as you will also see later on, although some people believe the WEP is unfair, it was actually created to make Social Security fairer by addressing an unintended inequity in the law. Social Security benefits are paid according to a formula that replaces a portion of the wages earned before retiring. The formula is designed to be relatively more generous to low-wage workers. For example, low-wage workers who will be paid by Social Security throughout their careers have about 53% of their average career wages replaced. In contrast, high-wage earners will have only 32% of their wages replaced. And this, again, is part of what the slide presentation is, too. Before the WEP was created in 1983, this weighting toward lower wage earners created a windfall for some workers who spent most of their careers in jobs not covered by Social Security, such as government workers. These workers received employer pensions that were often more generous than Social Security benefits. Well, that happens to be true, as you well know, if you are in a state university retirement system pension or in a state teacher retirement system or any of those. The longer that you participate in those programs, the higher the percentage that you get. So that's a good thing. This windfall arose because the Social Security benefit formula only counts wages earned in a job covered by Social Security. Wages from a job not covered by Social Security are not counted in the formula. As a result, the formula cannot distinguish between people who worked in low-paid jobs throughout their careers or those not covered by Social Security. From the perspective of people who paid into the Social Security throughout their careers, this windfall was unfair. Many people felt that middle and high income workers should not be given intended monies for low-wage earners. The windfall elimination provision was created in '83 to address this situation. Under the WEP, people with pensions from jobs not covered by Social Security receive a benefit reduction if they did not pay taxes into Social Security, which is pretty much everyone in this room. The WEP includes a guarantee designed to help low-wage earners and does not apply to survivor benefits. Although the WEP was created to make Social Security fairer, some people agree with you that the provision should be reduced or eliminated. As a result, Congressman Buck McKeon, Republican California introduced H.R. 147, the Social Security Fairness Act, which would repeal the GPO and the WEP provisions. This legislation was referred to the House Ways and Means Subcommittee on Social Security for their consideration. While I am not a member of this committee, rest assured I will keep your thoughts in mind as this legislation should continue through the House. As a former subcommittee chairman, I respect the legislative process in the House, which provides the Committee of Jurisdiction report legislation for consideration to the full House. In my role as Speaker of the House, I serve as presiding officer of the House of Representatives, and in this capacity, control the general flow of House floor proceedings. Consequently, in keeping with the practice of the House, I do not sign unto discharge positions. Nevertheless, I will continue to explore ways to modify the GPO and the WEP and to improve the fairness of the Social Security system for all workers. As Congress examines comprehensive Social Security reform, any action on this issue must be weighed carefully to ensure that workers are treated fairly and the Social Security solvency is not compromised. I appreciate your views on this issue, and I can assure you that your thoughts will be kept in mind as Congress looks at this important subject. Thank you again for contacting me. Please keep me informed on the issues most important to you. Sincerely, Dennis Hastert, Speaker. So this was a response that pretty much if you wrote to your congressman or to Denny Hastert, what you would get. So what we all need to know is basically what we're going to see in this presentation. And again, I don't have all the answers to some of your questions, but at least what this is going to do is help you to be able to get to the right person or people in the system to give you the answers. Okay? Yes? The bill number was H.R. 147, Social Security Fairness Act. And what with that, we'll get right into the presentation. Retirement. Retirement is basically, from a Social Security standpoint, looking at the three-legged stool. It actually could be four legs because they look at your pension, which is your defined benefit type plans, such as what you have in SURS or TRS, etc. Most private sector corporations no longer have defined benefit plans. They've eliminated them. They are now using defined contribution plans. That's where you hear about the 401ks, etc., etc. Okay? You have the capability of saving here at the college, which is the second part of the stool, and that is going to augment your state university retirement system. You can use 457s, you can use 403Bs, you can do IRAs outside the college. I think what it really is pointing out here is that Social Security, for the most part here, is not a part of your three-legged stool. You're going to be dealing with a two-legged stool. Okay? So somehow you need to shore up what is going on with the pensions side of it, which is your SURS, and also look at the savings side of it. Because if you're not going to be putting in 30-plus years here, you may have the problem of not having enough in retirement. So it's important to note that you need to have all of these elements working for you. This is what you need to earn to get Social Security credits. For each $970 in earnings, it gives you 1 credit. You can earn a maximum of 4 credits per year. In order to achieve anything from Social Security, you've got to have 10 years or 40 credits. Okay? And that's going to qualify you for some benefit in retirement. But this is where the problem comes into play too. Because the higher the number of years that you work in state university retirement system, this could also be reduced even if you have 40 credit hours. Your age also affects the benefits that you're going to get from Social Security. If you retire at 62, you're going to get less money permanently. But in my own case, I don't care. I'm probably going to be looking at taking the money at 62 because anything that I can grab prior to my death is going to be more beneficial to my spouse because she wouldn't get a darn penny. So I'm going to preserve what I have in my own 401k and retirement savings and use those dollars. Okay? This is another thought that you may want to come up with. At your full retirement age, you're going to get the full benefit. Again, if you don't have the offset coming into play. And obviously, you get more money if you work past the full retirement. Who else can get the benefits? Well, your spouse at age 62, and at any age for a child under 16 or disabled, divorced spouses may qualify. Here's another element that comes into play with divorced spouses. Medicare. As many of you may or may not know, if you are divorced and you've been married to someone for at least 10 years or longer, you still would be able to get the Medicare benefits. So if any of you here are contemplating divorce and you're married for only 9 years and 6 months, I would suggest you hang on for a little while just to get the Medicare benefits, okay? Your child not married under 18 and under 19 if still in high school, and if not married and disabled before the age of 22. These are all additional people who can collect Social Security benefits. Now, here's the interesting scope with respect to the year of birth and full retirement age. As you will note, as we get younger now, the full retirement benefit age goes out. So I don't know if there's any one of us in here that was born in 1937. I think not. I happen to fall into the broad range of the 43 to 54, which I like because no one can then tell my age. But if you're falling into these categories, you have to be in the system for that period of time to collect your full Social Security benefit. How the Social Security system determines what we get. Well, they take your adjusted wages for inflation. They find the average of your high 35 years, if you've worked in the system for 35 years, again, which most of you will not have 35 years in the system of Social Security. The result is the averaged indexed monthly earnings. What does that mean? Well, it means if your average monthly earnings are $4,200 per month, your benefit would be $1,681. And the way they calculate that, this is the standard computation. 90% of the first $656 equals the $590. 32% of the next $3,299 is $1,055, and the 15% of the remainder is $245. So your $4,200 monthly earnings result in a $1,681 Social Security benefit to you if, again, you are capable of getting the full benefit for Social Security. And this is basically what we went over a little bit in the letter, but it basically shows the low earner is going to get about 57% of his or her earnings in retirement from Social Security. The average wage earner, about 43%, and those that are considered highly compensated, and that doesn't necessarily mean the highly compensated that we talk about when we look at private sector, because highly compensated in the private sector fall into the range of $100,000 or more. So I think they're looking at someone in the $50,000 and up range is looking at a highly compensated wage earner. So 36%, I'm not exactly sure, but probably for the most part, the reduction gets to about 36% if you are a highly compensated earner. If any part of your government pension is based on work not covered by Social Security, this is all of you, you may be affected by the windfall elimination provision, the WEP, the dreaded WEP. Now, here's how that works. Remember the first computation that was 90% of the first 656? Well, it becomes 40% of the first $656. The other two percentages are the same, but the first is dramatically reduced. Now, here's the exception. If you've worked for 30 years or more in Social Security, and then you come here to the college and you work for another 30 years while you hit the jackpot. But I don't think that too many of us in this room would be able to work for 30 years in the Social Security system and still maintain a state university retirement system pension. So you can see what happens based on the number of years of coverage in Social Security as to what the percentage the first factor becomes in your benefit package for Social Security. Now, the government pension is based on work not covered by Social Security, or your Social Security or your spouse or your widower's benefits may be reduced. That's known as the government pension offset, the GPO. In each case, pretty much again, everyone here is going to be affected by the dreaded GPO and the WEP. The government pension offset, spouse benefits only. And remember, we said 2/3 of the amount of government pension will be used to reduce the Social Security spouse's benefit. The example shown here, if you're getting $900 of government pension, 2/3 of that is $600. If your Social Security spouse benefits equaled $500, boop, you get nothing, no cash benefit payable by Social Security. Okay? You can work and still get full benefits if you look and see if you're at the full retirement age, then you're going to get no limit on what you can earn if you're over. If you are at full retirement age, you can earn over $33,000 a year, but Social Security will withhold $1 for every 3. And if you're under the full retirement age at 62, and you go back to work, or 63 or 64, you're going to get, you can make up to $12,000 per year, but they're going to withhold $1 for every $2 you receive in Social Security. So it's kind of a penalty for going back to work, if that's the case, or, you know, may not want to go back to work. And this gets into the Medicare situation as well, because a lot of you are going to be involved with Medicare. I remember a case here from someone here at the college who'd only worked here at the college for many, many, many years and had no other Social Security benefits, and it was before that Medicare was even available to him to use. And for the last 3 years of his career here, he was going and working at so many different jobs, part-time teaching in the teacher's retirement system and all over the place, trying to get himself up to the 40 quarters to get Medicare. You don't necessarily have to worry about that any longer, but it's good to know that if you're 65 or older, you're going to get Medicare. And if you're receiving disability benefits for 24 months, if you have permanent kidney failure or amyotrophic lateral sclerosis, or ALS as it's more commonly called, those will all get Medicare for you. When can you sign up? Well, the initial age is at 65. There's special situations if you're working, usually in January through March. That's when you can sign up for Medicare. The coverage. Now, there's been some changes here with respect to Part D. Okay? And I've become acutely aware of this too, as my father, who passed away just a couple of weeks, we were dealing with Medicare there and all the bills that came from hospitals, etc., and all over the darn place. It does cover most inpatient hospital expenses. That 2006 deductible is $952. Once you've paid that, it's pretty much a pretty comprehensive coverage. Supplementary medical insurance covers about 80% of your doctor's bills and other outpatient medical expenses after the first $124 in approved charges. Your monthly premium there is $88.50, as it says. And then your prescription drugs, as you can see, the monthly premium for 2006 is $32. This is basically, again, going into the Medicare side of it. This is also available on the website for Social Security. But it's good to know how much is being paid for your drugs if you're taking medications. Here is the Medicare phone number. and the website to go into. So if you've got questions with regard to Medicare, it's a pretty good website. They give you a lot of good information with regard to you know, how much coverage you have, et cetera, et cetera. Well, if you're looking at your Social Security statement, the estimates of benefits are different retirement numbers for different ages. And I would suggest, as I mentioned earlier, if you do have questions that are privy to your situation, and everyone here is different, that you would either go to the website or set up an appointment at a local Social Security office, particularly if you're less than you know, 3 to 5 years away. For 10, 15, 20, who knows? The laws can change again. They may have some different situations that come into play. As we know the law right now, what we've just seen is something that is going to impact each one of you with respect to the windfall elimination provision and the government pension offset. So again, be very mindful that what you're looking at when you get your statements is probably not what you're going to be looking at in a retirement income from Social Security. Okay? I would suggest you go to the website. They've got some queries in there. You can go back and forth and actually do something on yourself and come up with an approximation of what you're going to be getting. You should at least call the year before you retire. But at this point, for many of you, I would start planning now, because again, what you're going to be looking at, if you look and think that you're going to get X number of dollars from Social Security, you may want to revisit your time frame in working here at the college. If you have 25 years or 27 years, you may say, I want to extend for another couple of years to boost your percentage from SURS. Or, by the same token, you may say, I want to possibly take a look at what my own defined contribution, 403Bs or 457 plans, so that I can go out with a percentage that makes sense for me, not necessarily only on my SURS benefit, but also what I'm putting into my outside plans. I want to thank you for, again, the opportunity. Do you have any questions with regard to what we've gone over so far? Yes?
You made a comment about having a spouse, an employee.
Yes.
What was your situation?
Yes.
Could you, and then you just went further and described something, so could you?
Yeah, what it is because my spouse has been working in the federal employment retirement system, the old system, prior to 1983, she elected, which you could have done. It's very much like what took place here at the college when they said you can either stay within the traditional SURS, or you can go with portable, or you can do your own optional. Well, they did the same thing in the federal side, and they said, but they mandated that everyone from 1983 and out would be going into the new system where they pay into Social Security. The prior employees from 83 and prior could stay within the old federal employment retirement system, or like a traditional SURS type of plan. She opted to do that, which would, again, in most instances, give you a much higher payout, very much like SURS. If you're going to reach your 34, 35 years, you're going to get a much higher payout than you'd get from Social Security. So, you know, that's out of the question for her. Why would she want to opt out? She already had 25 years in. It'd be crazy. But in the case that we're talking about with myself personally, the amount that she gets from federal employment retirement system, it is higher, much higher than what she'd be getting from Social Security. And because she gets that amount, and if I passed away with my Social Security, she would get nothing. As a spousal benefit. She would get Medicare. But she would get no spousal benefit with respect to retirement. Okay? Yes?
Does her federal pension impact your Social Security?
No. No. That's a separate entity. But it would impact hers. Yeah. Yeah.
What about the situation where your own Social Security is less than 50% of your husband's? You used to be able to choose.
That would be a query that I would go to the Social Security system to ask them. You know, That's a real specific kind of situation, and I would ask them. That's not in my repertoire of Social Security knowledge. I'm sorry.
Is that still an option for like stay at home?
Yeah, usually that's the case. Yes, they would get, like in my mother's case now with my father passing away, she worked, so she got her own portion of Social Security. My father was getting his portion of Social Security. He's passed away. We have an appointment in the next couple of weeks to go to Social Security, because what will happen then is his Social Security benefits are gone. However, hers will be increased to a certain extent because she will be getting a part of what his benefits were.
At some point, though, she could have chosen hers versus half of his.
Not while he's alive.
Right.
Not while he's alive. She was getting, I don't believe that that's the case. Again, I would contact Social Security with respect to the exactness of that. But I know in her case she was getting what she had, and it didn't appear that she was getting 50% of what his Social Security was.
I'm just wondering what the beginning number was.
Yeah.
That happened with my father. He passed away. My mother lost her Social Security, but she gets 50% of his because his was
It passed,
higher.
yes.
And
Yeah.
that's what she gets now.
Yeah.
Don't you lose the retire early though at 62? Isn't that only available if you retire at 65, the spousal benefit?
No.
I don't believe so, no. No, that's there. Now, again, it's reduced because of the age situation, but, yeah. Yes?
I want to refer to that windfall chart that you had.
Yes.
It said different years, like 20 years, 55%.
Yes, yes.
So when I get a figure on my Social Security statement and it says X number of dollars, I'm reading that windfall and it says I'll get 50, am I reading that I'm getting 55% of that only, or a part of that is going to be reduced by 55%?
No, that's going to be reduced. And again, that's a question that you would need to answer by Social Security once you get a firmed up amount you're going to get from SURS. Because that's where the combination of the two come into play when they start looking at what your benefit is. They take into account what your SURS benefit is, and then they'll reduce that Social Security benefit based on the higher amount that you're going to get from SURS. So the higher you go on SURS, the greater the reduction from Social Security. Yes?
That's only on the pension offset.
Yeah, on the pension offset. Yeah, pension offset, yes.
Do you know if the same thing happens with FERS, the federal employee?
The Federal Employee Retirement System, yes.
I'm entitled to get something.
Yes. Yes.
What I've done in the past. Now, will that be reduced because of SURS?
You have the old FERS, which is my wife that's in, and now you have SURS. So you got some years in FERS, you got some years in SURS, and you also have some Social Security benefits. You got a combination of the three. I would most definitely, prior to retiring, make a visit and an appointment with Social Security, and maybe set up 2 appointments, because you may get 2 different answers depending on where you go. Okay? I mean, that's the truth. I mean, the fact is, you may talk to one employee at Social Security and get one figure, and you may. So I would set up a couple of different appointments to find out exactly where you're at with it. Okay, that again is the sad reality of it. And again, for most of you here, you have 2 different schedules that you're going to be looking at with respect to your SURS. You can either use the traditional 2.2, or you can use the money purchase. In a lot of cases, the higher the number of years that you have in the system, they're going to use the money purchase plan, which would give you a higher percentage in your SURS pension. Okay.
Well, how can that be if you go to one and they give you one amount? Don't they put it in?
We're dealing with humans, and
Do we have a hot list of where to go then?
no. If anyone is here that has ever experienced that, getting 2 different answers from someone in the system,
Well, answer.
I know it has happened. It has happened. Yes.
The death benefit, spousal benefit, I have a question. If you have a child that's under 18 and you happen to be in retirement. Okay. And so if your spouse dies, then does the child's benefit, the child's benefit get affected as well? You know?
Don't know. Don't know. That would be probably not, but that's a probable. I couldn't give you a definitive answer there. Again, what I was trying to do with this today, and I think when Sue and I set this up, was just to get your wheels turning, to understand that there are some situations here that you're going to be dealing with in Social Security that may not be what you think they're going to be. So you need each and every individual here to understand where you're going to be with respect to your state university retirement system, pension, and then from there understand what you are probably going to be dealing with. And again, it's probably be dealing with from Social Security. And somewhere in between, you have to come up with the percentage that makes sense for you to retire in. Some people were always using, well, you need 70 to 90%. Maybe yes and maybe no. If you move to an area where your cost of living is lower, you may be able to get by on 50%. You know, if you're going to move to New York or San Francisco and go out to eat at fancy restaurants every night, then you may need 125% of what you were earning before you retire. So it's really all across the boards with respect to what percentage do you need in retirement. And I would venture to say most of you here, if you are participating in any one of the programs now, when you start backing out what you have outgoing from your check, it's very interesting in a lot of cases what I've noticed. Remember, you've got about 9% coming out for SURS. You got 3% coming out for your state tax. If you're doing anything with anyone's defined contribution plan, 403B or 457, you may be taking out another 10 or 15 or 20% there. You're not taking home 70% of your incomes now. So the reality is, don't be befuddled and go crazy saying, I got to get 100% of my income. You may not need it. Okay? That's the point, is you may not need it. But you don't want to go out and find out that you're only going to be getting 30 or 40% of your income and then have to go back to work at Walmart or you know,
Or COD.
or some other place. You would be much better served to stay here and work another few extra years just to get yourself in a much better position. So again, I think, you know, I appreciate everyone coming, and I know that the attendance was overwhelming. Hopefully we imparted some decent information to you, and I tried to answer as many questions as I could based on my limited knowledge of Social Security. Any other questions that you have?
Do you happen to know if there's a Social Security office in the Loop that has more knowledgeable people?
There is a Social Security office in the Kluczynski building, which is the federal government building. Whether or not you're going to be dealing with more knowledge there, I don't know. You know, I think if you go to someone and maybe, you know, get the questions answered, firstly maybe online, get some of those things taken care of. So you walk in and you've got a good base of knowledge. You're not coming in there totally cold. If you have some information and you're able to ask the right questions, you know, if that person that's sitting across from you from Social Security can't answer the questions, then they can refer you to their supervisor. Or if you're not getting the right information, you ask to be referred to the supervisor. That would be my response to that, you know, rather than go all the way downtown, because you may or may not be dealing with someone that's more qualified.
The Social Security and the IRS, where I walked in knowing more than they did.
That can happen, yes. Yes.
Are there any situations where a person would be able to receive the spousal benefit in addition to the SURS pension? What would qualify for that?
A very minimal amount coming from like a state university retirement system or a state teacher. Well, again, that would be dependent upon what the dollar amount would be. And that would have to come by making the visit into Social Security and saying, here's what I'm getting here. Am I, in fact, entitled to how much from Social Security based on what I'm getting here? So again, that's why it's so individual that you can't make absolute statements on it. Okay?
Yeah.
Yes?
That House Bill H.R. 147, how long has it been in Congress? Is it languishing? Has it been there for a couple years, 5 years, or?
I don't know the time frame. I know it's been discussed for well over a year or two. It's one of those things that's gotten pushed on the back burner. When it was initiated, I don't know. Don't know. But given the state of Social Security and given other things that are taking place right now in our federal government, I don't give it a whole heck of a lot of hope, quite frankly. Yes?
Do you know if it benefits you to apply for Social Security, say, in the state of Illinois, versus if you retire to an area that had a lower cost of living, but you didn't apply for Social Security until, you've been there a few years, say you're in, St. Louis?
That cost, the lowering, that has no, got nothing to do with your benefit. Your benefit is the same if you lived in Hawaii or if you live in Illinois. Doesn't make any difference. Your benefit is your benefit. This is why I say you'd better prepare yourself by knowing what percentage of dollars you're going to need income-wise in retirement from any different source that you're going to be deriving money from, whether it be SURS, whether it be Social Security, whether it be IRAs, 401ks, inheritance, whatever those dollars may be. You'd better have a firm handle in knowing that your cash flow, where you're going to be living, is going to put you in a situation where you are able to have a halfway decent lifestyle. Yes, sir.
I have a question about
Yeah.
substantial
Okay.
substantial earning years.
Yes.
If you have 30 substantial earning years, that you keep the 90% factor, but you talked to people who retire from a state or federal system at a relatively early age, before 65, may go back into the private sector and pay into Social Security again. Does that add back into those
Yes.
substantial
That
earning years?
That goes back into the Social Security system. So yeah. Now, if you're collecting Social Security already, remember the slide that showed how much you can earn?
I'm talking about before 65.
Before 65. That will add to your Social Security benefit. Yes, yes. That I do know.
But it would still be subject to...
It's still going to be yes, whatever those, once you in fact start collecting your Social Security, it's still going to be reflected on what you're getting from SURS too. Yeah, so you're not going to still get your full benefit more than likely.
But you may be paying your whatever percent in Social Security while you're working.
Yes.
You may not get any of it back.
Correct. Correct. It may not be enough to give you what you thought you might need back from Social Security based on what you're getting from SURS. Yeah, that's a possibility. So if you're going to go back to work, you have to be very cognizant that, what am I going back to work for? What's the dollar amount? How is it going to impact me later on with respect to am I working for nothing? It's just like someone here at the college that's, well, there aren't too many people here, but I have seen it at NIU, where there are individuals that have 40, 42 years, 43 years of service in. They have far exceeded what the state university retirement system requirements are for full benefits. In the last couple of years, I've seen at least 2 or 3 individuals that were so far in excess of their SURS retirement that they got back checks from SURS for in excess of $100,000 for overpayment into the system. So if you love what you do, then fine, stay on. But in most instances, from a monetary standpoint, in excess of 35 years may not be to your monetary benefit, folks, okay? Yes?
This WEP and this offset, is this national or only Illinois?
Oh, no. This is the windfall elimination provision and the government pension offset. This is the entire United States. Anyone that's in a position that has a federal, state retirement system, state university retirement system, they are going to be subjected to these.
Okay, because my mom retired from the University of California, and she gets both. And I thought she said she gets the full benefits of both.
She's got CalPERS, California.
University of California retirement system.
Yeah.
And she even questioned it, and the lady says, "Oh no, you're entitled to both." And then my dad gets half of her Social Security, because hers was more than his was for many, many years.
Yes, Sue?
So that's why I'm...
Can you just remind everybody what the 403B limits are for this year and what they will be?
Oh, yeah. That's a specific to the state. I would, this is generally all-encompassing with respect to those kinds of provisions.
If it's CalPERS, you pay into Social Security.
Yeah.
I was in that system.
Yeah.
You pay into Social Security and the pension system.
So it's like IMRF here.
Okay,
So,
This doesn't.
yeah.
okay, so that you get both back.
This only applies to pensions who are not, for work not.
Governmental, quasi-governmental. And Sue just mentioned to me to relay to you also what the contribution limits are with respect to 403Bs and 457s for the year 2006. And they are, you can do 100% of your salary in a 403B, up to $15,000. If you are over the tender age of 50, you can add another $5,000 to that to make it $20,000. There's also another catch-up provision, which I don't like to use, but you can use it, and it is the 15-year provision. And that allows you to take it up to possibly $23,000. Okay? But the $3,000 that you're putting into the program can only be used if you haven't contributed a substantial amount of your earlier years. So it is called a catch-up provision. So if you haven't done $10,000 per year over 10 or 15 years, then, and you have to have 15 years here at the college to be able to do that catch-up provision. It allows you to do $3,000 per year up to a maximum of 5 years or $15,000. However, I would say that one would not want to use that provision, generally speaking today, when you have the capability of doing a 457 side-by-side plan with a 403B, because then you don't have to worry about excess contributions going into a 403B. You can do up to 100% of your salary in a 457 at the $15,000 level, and also do the catch-up there at $5,000. So the combination of the two, if you're under 50, you can do $30,000 between a 457 and a 403B, and you can do $40,000 if you're over 50. A huge chunk of change, folks, that doesn't get you into the problem of utilization of the 3-year, $15,000 limit on the 15-year catch-up provision. Okay? Yes?
What's the difference between the 403 and the 457?
Basically, any longer, there isn't a whole heck of a lot of difference, other than the fact that on a 403B, you have to be 55 or over and separate service before you can start collecting. Okay? 50 on a 403B. Before you can start collecting without penalties, you've got to be 55 years old or older and separate service. Then you can collect on a 403B. A 457 gives you the capability of collecting at the age of 50 or over and separation of service. Okay? And that's the major difference. There used to be a lot of other differences. There were differences in contributions and so forth and so on. The Pension Act passed a couple years ago made all of the programs the same. 401ks, 403bs, 457s now have all the same limits, okay, and all the same catch-up provisions. Okay?
Do you know what the amount is for 2007?
It looked like there was a $500 bump from 15 to 15.5. I haven't seen what the catch-up provision is going to be, whether it's the 50 or over yet. It hasn't been firmed up completely yet, but more than likely it's going to be at least another $500. So it'll go from a $15,000 to $15,500 and maybe $20,000 to $21,000. We don't have it firmed up yet, but a rough guesstimate would be in that neighborhood.
Thank you.
Okay.
I have a question regarding
Yes, ma'am.
Social Security and SURS. From my previous sector, I worked 31 years. And I'm here, I've been at College of DuPage for 10 months. So where do that look with the SURS? I know the SURS is down.
You have 31 years in Social Security?
Yes.
You're no matter how many years you work here, you're going to get your Social Security. Okay. You are one that hit that bracket, okay, which I said there probably isn't anyone here. You're it.
Okay.
Okay?
I thought I had to be here
Good.
20 or 30 more years. I don't know.
No, you're going to get your Social Security without reduction. Now, the longer you work here, the more you're going to get from SURS too.
Okay.
So, good for you. You don't look old enough to have worked 31 years in Social Security. Yes?
To the 403B or the 457 for delaying withdrawals, and are those withdrawals, do those include spousal benefits, or are you making choices for different type of?
There are benefits, obviously, to delaying the use of your 403Bs and 457s. And this is, the simple fact is it keeps compounding tax deferred. And you don't have to take anything from your 403Bs or 457s until you reach the age of 70 and a half. Then mandatory required distribution comes into play. Now, shortly there's going to be a Roth here, perhaps, at the college, which is another entity to contemplate down the road, which may or may not fit in certain situations for certain people. The Roth 403B is a relatively new entity. It will be after-tax money, just like the regular Roth, that compounds tax-free. Now, that would probably be, if anyone here was going to use that, would be the last money that I would ever attack, because that keeps compounding tax-free. I would use my regular 403B or 457 monies first, knowing full well that at some point you're going to have to start taking withdrawals on that anyway. And again, it depends on what you're trying to achieve with the use of 403Bs or even Roth 403Bs. If your income streams, either individually or combined, are so high and you really want to save taxes, then by all means use the traditional 403B and the 457 to defer your taxes up front. But if that's not a major consequence for you, then maybe you'd want to think in terms of using some traditional 403B or 457 and some Roth that you will have continue to go out without taxes longer term.
Will you be able to convert any of your current 403B to a Roth 403B?
You probably can. I probably wouldn't do that because of the tax ramifications of doing that. I'm trying to think in terms of what the rules on that were, and it escapes me at the moment. I think you can, but again, it's going to be taxable in the year that you do that. I would have to check again the exact consequences now, because my mind is twisted at the moment. But it's another potential option. But again, I thank you for your attendance, and I hope that we gave you at least some information and got you to think with respect to the moves that you need to make regarding Social Security.